Hey, what's going on, everybody? It is Aaron Trevino here, and we have another wonderful guest from Baton Rouge, Louisiana. We have Sterling Chapman. What's going on, Sterling?
Oh, not much, Aaron. Thank you for having me.
Yeah, absolutely. I know this has been in the works for a little bit, so it's great to connect with you and looking forward to our convo today.
Absolutely.
Yeah, definitely, Sterling. So for those of us who aren't too familiar with you, would you introduce yourself, please?
Yeah, sure. So, my name's Sterling Chapman. I'm from Baton Rouge, Louisiana. I do a lot of single family and kind of small multifamily real estate projects here in South Louisiana, and then I spend a lot of time and energy on the large multifamily properties, which we syndicate. So that's kind of on about where most of my time is split up. I started in real estate about 3 years ago. I have a corporate job. I manage a big sales team, and I really like my job. And it's just few years ago, um, some of my bosses and partners and stuff at my corporate world got surplus, and it was weird because like I kind of built my entire identity around like what I did for corporate America, and like I was buying my first house like to live in, and I was about to get married, and I wanted to have a kid, and I was like, I just kind of pictured myself like being like in my 40s and like having like this big mortgage and these car notes and these kids in private school, and then like this whole life like that hinged on like one source of income, and then them just like turning it off because some guy looking at a spreadsheet, on the other side of the country that's never met me goes, oh, well, we could go down from, 28 managers to 23 managers and, in this sector and, shave a quarter of a percent off the quarterly earnings report. And just like that, like my entire life is upside down. So as when I got into real estate for like out of fear for like a safety net, and my initial plan was to just buy a couple houses a year and have the cash flow, pay my mortgage in case I got laid off. And and it escalated rather quickly. So the first year I bought two houses, and then the second year I think I bought 20, and then like the third, 2021 is the third year. I think we syndicated a 53 unit, and then I've bought 13 houses and a couple duplexes. So it's going, and now I have much larger goals and they grow, and my income has kind of outgrown my day job income. Um, and it's a whole different ball game than what I started. And I love it. And I'm very passionate about it. And I spend a lot of time and energy in the industry and, doing my podcast and networking and meeting with other investors. So that's how I bumped into you, Aaron. So I think that's the gist of it.
Yeah, definitely, Sterling. And I'm always fascinated by these kind of stories. A lot of times you hear these big, grandiose stories about someone taking a leap of faith, them making the jump. But for you, it's interesting how it seems like you were motivated by fear, fear of having those car notes, having that big family, having the private schooling, and you wake up and say, hey, I only have one source of income, right?
Yeah, it's weird. I think about this a lot because you do hear these like grandiose stories about like burn the ships, like quit your job and go ahead first. And you sink or swim, and like I guess wasn't that like courageous or whatever you want to call it. However, it works out for most people. Like I didn't do it that way. Like I feel like I had all the like fruits of entrepreneurship because I built this huge thing on the side, but without all the struggle that you hear about. Like you read these books of entrepreneurs that like clawing their way, like living in one bedroom apartments, eating like hot dogs and stuff while they're like setting their business up in their mom's basement and stuff. And like, I mean, I've always kind of maintained a regularly like comfortable lifestyle with my corporate salary, and I've been able to manage both. And oftentimes, every year since I started, we've gone through this kind of like seasonal layoff period, and this last one was like last summer, and I remember thinking like, okay, so like it'd be fine. All of my peers were like panic mode because they're like in the thick of that scenario that I just described. You know what I'm saying? That worst case scenario that I just described. They're like right in the middle of it, and I'm like, well, I mean, realistically, like I feel like if I quit my day job or if I got laid off, like I'd probably be better off long term. Like I would probably pour a lot more time and energy into my entrepreneurial pursuits and grow a lot faster. And I'm probably like, holding myself back a little bit by sticking to it. But I mean, it's just, I got a family, and it just makes I sleep so much better at night having the different options. And so I haven't jumped off the pier yet, but I'm hovering somewhere in the middle. And that might make me, not as hardcore of an entrepreneur as other folks that just burn the ships and quit their job. But I mean, I just haven't needed to. I've got a very flexible job, and I work from home, and I can do this on this computer and this on this computer. And I don't hate what I do. If I hated what I do and I was forced to do it 40 hours a week and I wasn't able to go do what I want for, real estate, then that would be different. And I would try and get out. But I guess I was just lucky I wasn't in that situation.
Yeah, no, absolutely. And like I said, it's very interesting hearing about how this, was this kind of came out of fear, right? Where, the fear of, looking long term and saying, well, hey, is this a life that I really want? Do I really want this lifestyle? And, it's neat that you were able to kind of assess, hey, these are my goals, and, kind of pushing forward, right?
Yeah, that's funny conversation that you bring up, because so I always did want that lifestyle. Like growing up, like my dad was a businessman. Like I always just kind of had this like I romanticized being like a big shot in corporate America, like wearing suits and like going to some fancy office. And like that was like my vision of what like cool was and like successful was. And then I got my MBA in like 2017, and that was around the time that I saw my boss get laid off. And then I'd also like started making like a decent salary. So I was like trying to figure out like how to invest my money. It was like the first time in my life where I wasn't like barely making rent. At that point, I was like, oh, I have a few extra dollars. What do I do with them? So I started reading like financial books, and Rich Dad Poor Dad was one, and that sunk in, and then in 2019, I'd already been investing and obsessed with real estate for a year at that point. But I got this job where I traveled a lot, like a lot. My wife was pregnant with her first child, and I was traveling 3 weeks out of the month, and I was catching planes home. And I remember like being in this uncomfortable suit with these like you can't breathe, and like my uncomfortable dress shoes like squeezed into an airplane at like 11 o'clock at night, flying home and being like, oh, it's gonna suck. When I land in New Orleans at 11, I'm gonna have to drive another hour to get back home. And I remember seeing like these like 55-year-old men doing the exact same thing in their like suits, you know what I mean? This just wrinkled, disheveled suits that you could tell they'd been in since like 5 o'clock that morning. And I was like, oh no, that's not cool. I don't want to be doing this when I'm 55. Like I want to be like wearing a fishing shirt and like golf shorts, like sitting next to my pool when I'm 55. Like I don't want to be like shoved in this tin can, like traveling at 11 o'clock at night. You know what I mean? And like my whole perception of like what success and what cool was like shifted there. And now it's hard to get me out of it. It's hard to get me dressed up. But yeah, that was just it was just a whole perspective change about what I wanted to do for the rest of my life. Because, in corporate America, if you work really, really hard, you'll get promoted and be able to work harder, like forever. Like,
No, it's super interesting, Sterling, how you're kind of having, it kind of seems like over time you were having really small paradigm shifts. And then at the end, it just kind of seemed like everything kind of changed for you and you changed direction.
absolutely.
Yeah, no, and it's interesting to hear about how it's kind of like, we grow up kind of conditioned to believe, hey, this is what's cool. I want to be the cool guy. I want to be the hotshot guy that people look at. I want to be the guy with all these toys and X, Y, and Z. But it kind of sounds like, you had a child on the way. I guess maybe things were kind of changing and you kind of had a shift in your perspective.
Yeah, absolutely. And I mean, you just as you get older, like I realized the time was more important to me than the money. You know what I mean? Like I didn't want to be like the way I was working for corporate America. Like if it would have continued that way, I'd have spent like the little league games, traveling or in a boardroom or something. And it evolved into like not being the lifestyle I wanted. I wanted move to not that I don't like, I work more now than I ever did, you know what I mean? But it is when I want to, and it's flexible, and like I could stop if like if something happened, if like one of my kids got there, you know what I mean, or something happened, like I could like totally check out, you know what I mean? And in corporate America, those demanding roles in corporate America, like you can't do that. You can't do that and keep moving at that pace.
Yeah, no, definitely. And it's great that you really had that self-awareness and really honesty with yourself and kind of recognizing, hey, this is what Sterling wants. This is the life that Sterling wants, and you're building accordingly.
For
Yeah,
sure.
no, absolutely. And I'm curious as well, if you wouldn't mind describing, I know you talked about kind of, your shift in perspective, your mindset, things were changing, you having this new insight on things, you reading Rich Dad, Poor Dad. If you wouldn't mind explaining maybe your first deal and what it was like.
Yeah, so my first deal wasn't really as impactful as like my third. So I'll just kind of give you the rundown. But my first deal was a single family rental. I bought it for $72,000, $72,500. I put down 15%, and I got a 30-year fixed. I got it my own name, a traditional Fannie backed mortgage on it. And so at the end of the day, when I put down 14 grand and maybe spent another five fixing it up. So I was like all into it for around 20 grand. And the mortgage principal, interest, and taxes was, or still is, 580 or 560. And I had it rented, and I've had it rented every month since I bought it for 1060. So for at first, I went around telling everybody I was cash flowing $500 a month, but in reality, you've got all these like maintenance issues. Like at one point, I had like an $8,000 sewer line, like that knocked out like a year's worth of profit. So, but luckily, I bought a bunch of other properties before I realized how much I wasn't actually making on that one, and so now they kind of like level out. But so that was my first deal, and then I bought another one, like the exact same scenario, like a month later, where I put down all in 20%, 15% or 20 grand, which was like 15% down, but paid 70, 78 maybe for that house. And it was rented for 1160. The note was 560. So it was $600 a month cash flow. And then I was out of money and I was broke. And I almost stopped buying houses because I was like, what? I got to, it took me however long it took me to save up that down payment. And I didn't have the money to put down or anything. So my third deal, which was very impactful, was because I used to read a lot and listen. I mean, I still do, but listen to like a lot of audiobooks and like Bigger Pockets podcasts and stuff. I was doing like a lot of like marathons and stuff at the time. So I was always running. I was always listening and stuff. I was like about to quit because it would just piss me off. I'm like, oh, I'm listening to all this like real estate content, but I can't do anything. But instead, I just like I kind of switched gears to these like low and no money down type of strategies, and I came across like the Burr strategy, and so I got these two duplexes that were side by side, and they were like one was flooded and one was just like trashed a little bit, and I got both of them under contract for $190,000. Now I was completely broke, and I had zero experience fixing up anything, but I had a friend who flipped houses, and he had investors that funded his house flipping business, and I knew there was a lot of meat on the bone here. So I was like, hey, look, if you use your investors to buy this property, add me to the title, and you like manage the fixing up because I don't know what I'm doing and you do, I'll give you 50 grand. And he was like, okay. So, we bought the property, he fixed it up. It appraised for 390, yeah, like 195 a piece. And so the bank gave us an 80% cash out refinance. So they wrote me a check for 312 grand. So I paid his investors I paid for the reno. I paid him 50 grand. I paid back the investors that bought the property. And I walked away with $80,000 in equity and $2,000 a month in cash flow.
Beautiful,
And
beautiful. And I mean, that's really a testament of faith almost, right? Just kind of putting one foot in front of the other and figuring it
yeah,
out and getting help.
I didn't sleep for 6 months waiting for that to work. Yeah. It was stressful not having the proof of concept or anything like that, but it all worked out well. And I've done it multiple times since then. And it always pretty much works out well.
Yeah, no, absolutely. And I mean, that's great to hear that you, I mean, you really, you kind of recognize, hey, I'd never really, you didn't really have that experience flipping the houses, but you did have, some people with some cash and you kind of tied everything together and it sounds like you got it done.
Yeah. Yeah. I still have all those properties. Um, I just refinanced it again a month or two ago, and they reappraised at 210 a duplex. So that 80,000 in equity that I started with ended up turning into 100,000 in equity. Or
Okay.
no more than that. It's a 210 a duplex. That's 420. So 110,000 in equity.
Okay. Fair enough. No, that's, so, I mean, you talked a bit about, your first deal, I guess it really clicked and it sounds like a third time was the charm, right?
Hmm.
Yeah. So, I'm curious as well. I mean, are you looking to do more single family homes or, kind of what are you doing now and what are you looking to do in the future?
So I spent a lot of time with the larger multifamily projects. We syndicated a 53 unit project in Noonan, Georgia, earlier this year, and really enjoyed working on that project. We're looking at a couple other larger deals like that. I spend a good bit of my time and energy dealing with the larger multifamily source, and I work with my partner at Crestworth Capital is the company that we started to do our syndications with. I just finished writing a 14-page ebook on why you might want to passively invest into large multifamily syndications. So you can go to crestworth.com and download that for free. Um, and I still do the single family houses. So I have this year I have bought um, a, a lot. We just had a flood in Baton Rouge, so there's a lot of properties that like flooded that I was able to get a good deal on. So I've let me see. In the last 2 months, I've bought 7 houses, and I'm closing on another one tomorrow, and I have two more under contract. So they're all great deals. They all cash flow a couple $100, and I'll end up with 50 to 75 grand in equity in each little deal. So, I mean, it in between apartment complexes, it's a great way to just continuously build your cash flow and your net worth.
Yeah, no, absolutely. And it's interesting as well how a lot of people will say, hey, I want to start out maybe like Monopoly, right? You want to start out with maybe smaller units and then kind of build into larger ones. Whereas, it kind of seems like some people that transition to multifamily will easily turn their back on the single family homes where you could make money.
Yeah, I don't know why they do that. I mean, I understand why Joe Fairless doesn't waste his time buying single family houses because he's taken down 400 unit complexes, twice a month. Like I get it. It doesn't make sense in that regard. But for a lot of folks I know that are like, hey, I have 4 single family houses. I'm not going to do any more single family houses. I'm only going to do apartments. And they've only been doing apartments for 18 months and haven't bought an apartment. Like, do you know how much you could have grown your net worth and your cash flow over the last 18 months if you had been buying single family houses, or why you were buying apartments, why you were looking for an apartment? Um, and I'm not knocking them. I'm just telling them not to knock me. Like I like it. I like doing both. So
Yeah, completely. And I mean, regardless of, where you stand, I like your approach, Sterling, where, you're kind of using one to feed the other in a way, right?
sure. And I don't sell houses. So and a lot of it is because I don't need to because I have the salary. Um, and early on, a lot of my purchases were more cash flow oriented. Now they're closer to, now they're more heavily on equity in nicer areas that will appreciate and not as heavy on the cash flow. But if I could always sell them, I just don't need to because I have other sources of income. A lot of folks that burn the ships and quit their job and go right in, they have to flip houses because they have to live off of that that revenue from selling the houses. My idea is just as long as I don't need it, like I'll just keep it, stick it in the corner, let it keep baking. The longer it sits there, the more the tenants are going to pay down your note and the more it's going to appreciate.
Yeah, no, absolutely. And that's a great strategy to have, Sterling. And I'm curious as well, you talked a bit about, the first few deals you got. You talked about a bit of flooding as well. I've been to New Orleans. I've never personally been to Baton Rouge. For maybe those of us who aren't too familiar with Baton Rouge, could you kind of explain the layout of the city, maybe what the economy is like or the market?
Yeah. So there's North Baton Rouge is, and some people would be pissed off to hear me say this, but it's reality. North Baton Rouge is like the lower income area where it's not, a great place to buy anything if you ever want it to go up or if you don't want to get shot trying to collect your rent. And I own some houses in North Baton Rouge, but the South Baton Rouge or like kind of Midtown is where there's nicer properties. A lot of the is what I'm getting now is the nicer properties. Whereas when I first started, it was more North Baton Rouge. There is overall our economics suck. So I mean anybody who's I'm sure looked into it has saw like Louisiana, Mississippi, like we're like the bottom two every year in everything from crime to poverty to education. So, I have a lot of properties here in South Louisiana that are like smaller properties that I can like wrap my arms around. Like I know that neighborhood real well, or you know what I mean?
Yeah.
But when it comes to like raising millions of dollars to buy large multifamily assets, and you really want to look at like the macroeconomics, um, which is around like population trend. Are people moving there? Are people leaving? Um, the the poverty levels, the crime rate, the job diversity. South Louisiana, we got first of all everybody's leaving. The population is decreasing. There's no job diversity. Like everybody here relies on the oil field. Crime is high. Poverty's bad. Median household income's low. Like it just doesn't have the the numbers to support, in my opinion, somewhere I want to buy a multi-million-dollar asset. So I have a bunch of little assets here.
Yeah, no, that definitely makes a lot of sense. I mean, like anything else, you're doing your own due diligence, and it's good to recognize where you can do certain types of deals.
Absolutely.
Yeah, definitely, Sterling. Well, is there anything that you haven't said that you really just like to hit home for us?
No, I would, when I first started, I wanted to, I was like evangelical about it. Like, why isn't everybody doing this? Why isn't it like, y'all are crazy? To the point where people got tired of it. That's why I started my podcast. People got my friends and family got tired of hearing about it, but some people just don't want to hear about it, and that's fine. But it's absolutely changed my life. And a lot of folks that reach out to me, they kind of get bogged down in this like analysis paralysis type of state. And they send me like 50 first deals. And I always tell them like, it really doesn't matter. Like I lost money on my first deal. I mean, overall, I probably haven't over the last 3 years, but like that first year I did for sure with the $8,000, sewer line. um, uh, what really matters is that you get started and that you keep going. It's going to be hard to like we have the proof of concept, right? You're not out there selling some like new fancy like developed magic pill or magic app that like we don't know if the market's going to react to it. Like we got a pretty tried and true product here that the proof of concept is there. More millionaires have been made in real estate doing it this way than anything else. Like there's no like question about is this going to work. The only question is like, are you going to quit before it works? So I would just encourage people to just kind of keep you can't make these decisions based off of such a small sample size. I see some people like they'll buy like that one house, like, well, we'll see how this goes before we buy another one. And then they'll have the sewer line issue and they go, oh, well, we lost money. That doesn't work. Like, well, it doesn't work on one house, but if you had 100, like you wouldn't notice that sewer line. You know what I mean? So I would just encourage people to get started and just to keep going.
Yeah, definitely a lot to be said for that. And, it was interesting hearing that story, about you finding out that you had, an 8K bill for that sewer line. And, you talked about if maybe having more units could kind of offset that risk, when that happens.
Yeah, absolutely.
Yeah, for sure, Sterling. Maybe someone's listening. Maybe they're in your backyard. They're in Baton Rouge. Maybe they're somewhere in Louisiana or another part of the country. How do we get in touch with you? Where can we find y'all?
Yeah, I'm everywhere. So I have a podcast of my own. Like I said, it's the Rent Roll Radio Show. Um, Please chime in, listen to it. You could send me an email at sterling@crestworthcapital.com. I have two websites. I have sterlingchapman.com and I have crestworthcapital.com. If you go to crestworthcapital.com, you can get that free ebook that I wrote on why to passively invest in apartment syndications. And you can feel free to text me or call me at 225-247-5562. Like I said, I like to talk about real estate more than my friends and family like to hear about it. So I'm always open to meet up with anybody and chat.
Yeah, absolutely, Sterling. Well said. We've covered a lot of ground today. Talked a bit about your background, a bit about the Baton Rouge market, a bit about maybe some of the paradigm shifts you have, perspective changes, and what y'all do in the market. So it's been real insightful. And thank you for coming on the show.
Awesome, Aaron. Thank you for having me.
Talk to you later.